Joining us now is Dan Niles from Niles Investment Management. Dan, it's good to have you back on the show, and that's exactly where I'm going to start with you. Given what we have seen, this downdraft in stocks, would you be a buyer here?
Well, it depends on if you're talking long-term or short-term, but right now I think over the short term, when I saw the market down this morning, I started going in and doing things like shorting volatility where I thought we would hopefully see a pickup in a rally. Obviously, I wasn't expecting what happened intraday where the market goes from being down 4.7% to up 3.4 and then back to, below flat. But I think it shows you that unlike prior drawdowns that you've seen, global financial crisis, you're not going to fix the problem in a day because you've accumulated tons of bad mortgages. You're not going to fix COVID because it's a global pandemic in a day. You're not going to fix the tech bubble meltdown because you overinvested for 5 years back in the late 1990s. This you can literally fix overnight if everybody, resettles the tariffs, because this is a self-inflicted wound. And I think that's what you saw with that move from down 4.7% in the S&P to up 3.4. And so I think what that does is it makes it so that in the near term, the path of least resistance is probably higher. Now, if you look long term, the one thing that brought me into this year, if you remember, one of my top 5 picks was cash. I had no Magnificent Seven in my top 5 picks. I was negative coming into the year before all of this stuff started to happen. And the issue was valuation, which nobody wanted to talk about who was bullish. And now everybody who used to be bullish is talking about valuations, which have dropped from 25 times trailing on the S&P down to 21. The problem I had was with inflation at these levels, the average S&P should be around 19 times. And so that's still another 10% lower from here. So I think the short term, I think you're going to see a bounce and you're going to see that continue. Longer term, I'm always focused on how much you're paying for things. And that's the thing that would keep me a little bit more cautious longer term.
So in light of that, let me play this soundbite from Jeffrey Gundlach, who is on in the last hour with Scott Wapner. Take a listen.
We have a lot of dry powder, and I talked about cash as a recommendation on Fed days for the past few Fed days, as much as 25 or 30% cash. I would not be deploying that cash yet. I think you're kind of in the middle innings of this thing, although certainly the market going down so much on Thursday and Friday, it's a little bit disconcerting that we don't have more of a bounce in the market.
Sounds like you think we're in middle innings or maybe middle towards getting towards the end if you're talking about maybe another 10% drawdown here for the S&P. So assuming that happens, assuming we fall further, at some point here in the near term, we get even more washed out. Some of those technical levels are realized. Some of those valuation metrics that you just mentioned are realized. What would you be nibbling at first?
Well, I think it's very company specific. So I think, there are certain names that I went into recently. But the big thing I would focus on is which companies are generating a lot of cash, which ones tend to pick up market share during recessions. Those are the types of names that you want to be in, because if you're in stuff where, 10 years from now, it's going to be a big market, you're going to get absolutely murdered if you get into a recession. And so that's the stuff I would avoid, I guess, in that scenario. And don't forget, even if you go back to the global financial crisis, when the S&P was down 57% from peak to trough, you had 11 rallies in the S&P 500 of 10% each. 11 of 10%. And I guarantee you're going to get, or you can't guarantee, but it's highly likely, given what happened the last time, that you're going to have stuff like that happen again, and you're going to have the bullish analysts come out yet again and tell you how the market's going to be up 20%, trying to ignore valuations. But I think until you have the economy settled down, you want to stay in the cash generative names, profits today, not 10 years from now, where the multiples discount the risk. And I think the AI trade, now that you've reset some of these valuations a lot lower, those are some of the names you can go back and look at, and that's some of what we did today.